Okay, so the next issue that we need to look at while considering incremental cash flow for capital budgeting projects is the question of depreciation. So, as I'm sure you remember, depreciation is not a cash expense. And so, if we want to understand what a cash flow is from a project, um, the simplest way to do that is if we have an estimate of the net income from a project, then we add back depreciation. And the reason that we have to do it that way is because of taxes, right? Because depreciation comes out before you pay taxes. So you have to look at depreciation at the beginning of your cash flow calculation and then take it back out at the end. Okay, so that's sort of cutting to the chase. There's two ways to depreciate capital expenditures. One of them is straight line, that is the easiest to calculate by far. And then there's MAKERS, modified accelerated cost recovery system, which is basically it front loads your depreciation expense. So straight line depreciation is, like I said, it's easy to calculate. You just take the capital investment and you subtract out the residual value, and then you divide that by the number of years. We went through this in some detail in 213 to figure out your annual depreciation expense, again, which is not a cash expense. MAKERS is fairly detailed. Going through it in detail, I'm not going to get into in this class. I keep saying this, but we'll do it if you want to take an upper level finance class with me. But again, like I said, it just front loads your depreciation expense. So if we look at this table here, this says the annual expense percentages by recovery class. Recovery class means the expected life of an asset, and so a 5-year asset. Basically, they assume that you buy it halfway through the first year, so you get 20%. You get to depreciate 20% of the cost of the asset your first year, and then 32% your second year, and then that trails off. And again, because you are assumed to buy it halfway through the first year, you get a little bit of residual depreciation in that 6th year as well. Right? So you apply these percentages in this table to the cost basis of your asset to come up with the depreciation expense. Right? So that's how you come up with depreciation expenses every year. And then they go through, how to actually calculate them. And as I said, it basically front loads your depreciation expense. So it makes it more attractive to make that capital expenditure because it reduces your taxes, right, at a faster rate. Okay. And that is sort of the whole, it's a very, very quick overview of this whole question of capital spending and depreciation. But in the next section then, we look at cash flows and the disposal of capital equipment. Because back in financial accounting, you would have had to look at the book value of your asset and then compare that to the actual cash that you get in the payment of the asset, and then you have to declare a loss or a gain depending on the relationship between the book value and the what you sell, right? So actually, let me find that piece here and highlight it. Okay, so if the selling price is greater than the book value, there's a tax on the gain, and the after-tax cash flow is the selling price minus the taxes on the gain. If the selling price is less than the book value, there's a tax credit as a result of the loss, and the tax credit reduces the overall tax and is therefore a cash inflow at disposal. Okay, so this is some nitty-gritty details. I don't think I give you a quantitative problem where you have to actually solve this out. I just want you to kind of know that these are issues that need to be addressed in capital budgeting. And so this goes through an example of how to calculate out the loss on the sale and the book value and all that kind of stuff. We're not going to worry about that in this class. But we can sum it up by saying after-tax cash flow at the disposal of an asset. Okay, if the selling price is greater than the book value, then the net after-tax cash flow is the selling price minus the tax on the gain. And if the selling price is less than the book value, then the net after-tax cash flow is the selling price plus the tax credit on the loss. And if the selling price equals the book value, then the net after-tax cash flow is the selling price. Okay, so we're going to leave it there for depreciation, and then we are going to talk about projecting the cash flow for a new product.